Imagine, checking your portfolio and realizing that the 4-year totally reliable heartbeat of the crypto market has just completely flatlined.
Yeah, the one that everyone relied on.
Right, the exact same cycle that made millionaires in 2017 and then again in 2021. And here we are, early 2026, and Bitcoin plummeted nearly 50% right when all the historical models that it was supposed to go, absolutely parabolic.
It's definitely shaking a lot of people up.
Seriously. So today, we have this massive stack of sources to try and figure out one frankly terrifying question for you. Did the crypto cycle actually break? Or did Wall Street just come in and rewrite the rules entirely?
I mean, it's a massive shift, and you really have to look at the underlying data to see it.
Exactly. We are pulling from the 2026 Coinbase Market Outlook, institutional reports from Silicon Valley Bank, KuCoin, and some incredibly deep technical analyses on blockchain infrastructure.
Yeah, the infrastructure stuff is huge right now.
It really is. So our mission for you today is to cut through all the noise and figure out exactly what is driving crypto's next phase. We're talking Bitcoin's new cycle, the signals for this looming alt season, and that multi-billion-dollar tech war between Ethereum and Solana.
Right. These strategies that worked 3 years ago, they're literally actively losing people money today.
Okay, let's unpack this. And I want to emphasize right up front that we are going to look strictly at the hard data. We are leaving all the hype at the door today.
Sounds good.
So let's start with the anchor of the whole market, right? Bitcoin. Looking at the recent timeline from our sources, the script actually started out exactly as everyone expected.
Yeah, it really did at first.
Right, like April 2024 hits, we get the halving of miner rewards down to 3.125 Bitcoin. And historically, that sets the stage for a massive supply shock.
Which is exactly what happened. I mean, it mirrored the classic post-halving lag we saw in 2013, 2017, and 2021, almost to the day.
It led straight to that massive $126,000 peak in October 2025.
Exactly. The supply of new coins gets cut in half, demand stays constant or grows, and the price just squeezes upward.
Wait, hold on though, because if everyone and their mother knew this halving pattern, shouldn't the market have just priced it in early?
You'd think so, yeah.
And more importantly, if that supply shock is permanent, why on earth did we see a 45 to 50% dump back down to the $67,000 to $75,000 range by early 2026? Because for years, I've thought of this 4-year cycle like a mechanical metronome. Tick-tock, halving, bull run.
Right, the 4-year clock.
Yeah. So I have to ask you, are the cycles fundamentally broken now? Or has that 50 billion sitting in spot ETFs created some kind of giant, bizarre shock absorber?
What's fascinating here is that the cycles aren't dead at all, but they are maturing in real time.
Maturing how?
So Bitcoin is officially graduating into what the reports call its global macro asset phase. To understand why this current drop feels so jarring, you really have to look at the historical context.
Okay, lay it out for us.
When previous bear markets like, say, 2014 or 2018, a post-peak drop was just catastrophic. We are talking 80 to 85% drawdowns.
Wow, yeah, complete freefall.
Exactly.
Just retail panic, selling into the void, because honestly, there was no underlying foundation.
Precisely. But a 45% drop from an all-time high. In traditional volatile assets, that is just a standard healthy market correction.
Oh, interesting. So it's not a crash?
No, not at all. The KuCoin analysis explains that we didn't drop because crypto failed. We dropped because of a macroeconomic liquidity vacuum.
A liquidity vacuum, meaning the Fed?
Right. And during 2026, the Federal Reserve shifted back to this higher for longer stance on interest rates to fight sticky inflation.
So
when the cost of borrowing money goes up, excess liquidity just gets sucked right out of the global market. Institutional profit-taking kicked in at that 126,000 top.
All right.
And it led to a massive deleveraging event.
So they basically took their profits and ran, triggering the slide.
Exactly.
But that doesn't explain why the slide stopped so abruptly, right around $60,000.
Well, that is where your shock absorber theory actually comes into play.
Oh, really?
Yeah, the ETF inflows established what analysts are calling an institutional floor between $60,000 and $65,000.
An institutional floor?
Right, because that $115 billion in spot ETFs isn't just speculative day trading money.
Okay, so who is it?
It's pension funds, endowments, long-term allocators. They are treating Bitcoin as a strategic reserve asset now.
Oh, I see.
So when the price dips toward that 60K range, which happens to be roughly the volume-weighted cost basis for those early ETF buyers, they simply buy the dip to rebalance their portfolios.
Like a massive net catching the falling knife.
Exactly.
That makes a lot of sense. They aren't trying to time the top. They are just, maintaining a 1 or 2% portfolio allocation.
Right? Just basic rebalancing.
So when the price drops, their allocation shrinks, so their algorithms just automatically buy more to bring it back up to target.
You nailed it. And our sources actually mention a specific metric these pros are using to signal when it's time to accumulate.
Right, the MVRVZ score. Can you break that down for us?
Sure. So the MVRVZ score compares Bitcoin's market cap, which is the current trading price, to its realized cap.
And realized cap is what, exactly?
It's the value of all coins based on the price they last moved at. So essentially, it compares the current market value to the actual historical cost of acquiring the network over time.
Think of it like checking the Kelley Blue Book value of a used car versus what the dealer is actually asking for it on the lot.
Yeah, that is a perfect analogy.
So, when that score drops into what analysts call the green zone, it means the market is pricing Bitcoin for less than the historical average it cost to basically build or acquire it.
Right? It's a literal clearance sale.
Wow.
And beyond just the cheap prices, we are seeing a massive structural change driving all this accumulation. I'm talking about the FASB fair value accounting rules that took effect in late 2024.
Right, the FASB rules. I want to spend a second on this because it sounds, honestly, incredibly boring. But it's actually the secret engine of this whole cycle.
Oh, absolutely. It changed everything for corporations.
So how did the old accounting rules actually prevent companies from holding Bitcoin?
Well, under the old rules, Bitcoin was treated as an indefinite lived intangible asset.
Which means what, in plain English?
It means if an S&P 500 company put Bitcoin on their balance sheet and the price dropped for even a single day in the quarter, they had to record an impairment charge.
Ouch.
Yeah, that meant they had to report a loss on their official earnings, hurting their stock price, even if they didn't sell a single coin.
That's brutal. But what if the price went up, say, 300%?
That's the kicker. They couldn't claim any of those gains until they officially sold it. It was all downside risk on paper.
So it was essentially an accounting penalty for holding crypto.
Exactly. But the new FASB rules let them report the fair value in real time.
Right. So if the price goes up, their balance sheet just gets stronger immediately.
Which is exactly why you are seeing these wild, seemingly impossible price targets for the end of the decade.
Like what?
Well, Standard Chartered is targeting $150,000 to $200,000 based on the historical trajectory of gold ETFs, and Bernstein analysts are calling for $500,000 by 2030.
$500,000. Wow.
Yeah, the scarcity mechanics of the halving are finally colliding with this frictionless institutional adoption on corporate balance sheets.
Okay, so if Bitcoin is maturing, consolidating, and sitting comfortably on this new institutional floor, like a boring blue-chip tech stock, naturally, all that risk on capital starts getting pretty bored.
They definitely get bored.
And in crypto, when capital gets bored, it goes looking for higher, more adventurous growth. And that causal link brings us directly to the signals for alt season 2026.
It's the classic rotation of capital. Bitcoin stabilizes, the liquidity builds up, and eventually it overflows into the broader higher-risk digital asset ecosystem.
And the data is definitely flashing some major signals here. According to the MEXC news source, Bitcoin dominance, which is just the percentage of the total crypto market cap made up by Bitcoin alone, has been stuck in this incredibly tight coiled spring.
Right, between 58.8% and 60%.
Exactly. But analyst Matthew Hyland points out it is currently flashing a massive breakdown signal.
The death cross.
Yes, a death cross on the monthly chart, potentially signaling a crash below 40% dominance. Meanwhile, the altcoin season index is creaking up from 22 to 37.
Shift is starting.
But the ultimate trigger for this altcoin explosion isn't just, lines on a chart. It is entirely legislative.
Yeah, the regulatory landscape is basically the dam holding back all the water right now.
And just a quick aside for you listening, we're looking strictly at the data and market catalysts here. The sources highlight specific political figures like Donald Trump and legislative pushes like the Clarity Act and the Genius Act expected by late 2026.
Right, the political side of things.
Yeah, and we aren't taking any political sides today, nor are we endorsing anyone's politics. We are merely following the financial analysts' maps to see where trillions of sidelined dollars are just waiting to be unpaused.
And it is crucial to understand why that legislative momentum is the ultimate catalyst. It really all boils down to legal risk.
Legal risk.
Yes. Right now, Tier 1 banks, massive insurance companies, sovereign wealth funds, they have incredibly strict internal compliance mandates.
So a compliance officer at, say, JP Morgan, cannot allocate client capital to an asset if its legal classification is ambiguous.
Exactly. Is this token a commodity? Is it an unregistered security? If the SEC might sue them tomorrow for holding it, they simply won't touch it.
So it's not a lack of interest at all. It's a literal legal barricade.
Exactly that. The Clarity Act and these proposed market structure bills aim to provide a definitive black and white framework for those classifications.
So clarity is key.
Right? Once you remove the fear of arbitrary enforcement actions, the friction is just gone. The massive capital sitting in traditional finance can safely flow into smaller altcoins, DeFi protocols, and smart contract platforms.
Okay, let's say the Clarity Act passes tomorrow. Wall Street unpauses trillions of dollars. It just floods into the market.
That's the dream scenario.
But the terrifying question is, can the current networks even handle that volume without completely crashing?
That is the multi-billion-dollar question.
Because historically, when retail hype spikes, gas fees go to the moon, and the networks just freeze.
Yeah, nobody wants to pay $100 to send $20.
Exactly. And that brings us to the fundamental infrastructure war of 2026. Ethereum's Pectra upgrade versus Solana's FireDancer client.
This is where the theoretical white paper debates of the past few years have finally turned into deployed measurable reality.
Here's where it gets really interesting, because both of these networks rolled out seismic foundation-altering upgrades just weeks apart in late 2025.
They did, yeah.
Let's look at Ethereum first. The Pectra upgrade in May combined execution and consensus layer updates. But the absolute star of the show, based on the Blockian source, is EIP 7702.
Right, the one that brings account abstraction to the mainstream.
We hear that buzzword everywhere, account abstraction, but explain the actual mechanics of how it changes the user experience.
Okay, think about the traditional, honestly painful crypto user experience.
Oh, I know it well.
Right, if you want to send someone a USD coin on Ethereum, you can't just send it. You first have to go buy Ethereum to pay the gas or transaction fee.
Which is super annoying.
Then you have to sign complex cryptographic messages manually. If you lose your 12-word seed phrase, your money is just gone forever. It is terrifying for a normal person.
So what does EIP 7772 actually do?
It allows a standard basic crypto wallet to temporarily upgrade itself into a programmable smart contract during a transaction.
Wait, so you're saying the wallet can suddenly follow complex rules instead of just being like a dumb digital safe?
Precisely. It enables gas abstraction. A decentralized app or developer can actually sponsor the transaction fee on behalf of the user.
Oh, nice.
Or the user can just pay the fee in the stable coin they are trying to send. It also allows for batch transactions.
Batch transactions meaning?
So instead of clicking approve 5 separate times to make one trade on a decentralized exchange, you just sign once. It hides the blockchain infrastructure behind a smooth interface, making it feel just like using Apple Pay.
That is massive for consumer adoption.
Really is.
But while Ethereum is focusing on user experience and relying on these external Layer 2 networks to handle the heavy lifting, Solana is taking a completely opposite approach to scaling, right?
Absolutely. They rolled out the FireDancer validator client in December 2025.
And this isn't just a software patch from what I read. It's a complete re-implementation of the Solana code, written entirely in C by Jump Crypto.
And writing it in C is the crucial detail here.
Why is that?
Because the original Solana code was incredibly heavy. By rewriting it from scratch in a lower-level programming language, FireDancer bypasses the original software bloat.
Oh,
It directly optimizes how the network interacts with the physical hardware, like the CPUs and network card.
that sounds intense.
Yeah, the sources note it's currently running as a hybrid called FireDancer, holding about 26% of the validator market share.
Okay,
But here's the kicker. Even in this hybrid state, validators running FireDancer are boosting their staking rewards by 18 to 28 basis points.
wait. How does making the software more efficient actually print more money for the people securing the network?
It's all because of latency. In a blockchain, validators constantly compete to process blocks of transactions and earn the fees.
Right.
FireDancer processes data so much faster that these validators are able to propose blocks and vote on them milliseconds quicker than the older clients.
So they just beat everyone else to the punch.
Exactly. They miss fewer opportunities, drop fewer packets, and therefore capture way more of the network use.
Wow. So efficiency literally equals yield.
It does on Solana.
And the numbers they are chasing long-term are staggering. The goal is 1 million transactions per second. Now, I have to be skeptical here.
Go for it.
The sources clarify that 1 million TPS is a realistic target for maybe 2027 or 2028, and they are currently doing only 3,000 to 5,000 TPS. Is 1 million just marketing fluff, or is that actually required for global finance?
Well, if you want to put every NASDAQ trade, every single credit card swipe, and every high-frequency algorithmic trade on a single shared global ledger, yes, you absolutely need millions of transactions per second.
That is wild, which actually makes me think of this analogy. Ethereum has decided to become a sprawling, highly secure financial district like Manhattan.
I like that.
It's expensive and congested on the main island, so it absolutely relies on all these Layer 2 suburbs connected by train lines to handle the massive population. Wall Street trusts Manhattan because it's secure,
Yep.
but Solana is trying to build a single blazing fast metropolis where everyone lives, works, and trades in the exact same giant room.
That perfectly illustrates the trade-offs. Ethereum is winning the institutional trust game hands down right now.
Because of decentralization.
Exactly. It has over 8,000 validators, an incredible client diversity, making it highly decentralized and resistant to censorship.
Makes sense.
That is why it commands over $50 billion in total value locked in DeFi. Wall Street will put $1 billion on Ethereum without blinking.
And Solana?
Solana, with its roughly 3,500 validators and 8 billion in TVL, is prioritizing the consumer experience. Fast, cheap, instant global state.
So they serve different purposes.
Yeah, we aren't arguing about which chain is better anymore. We are witnessing a permanent bifurcation into specialized solutions.
Okay, so we have the secure Manhattan and the blazing fast metropolis. But what is Wall Street actually doing in these cities right now?
Good question.
Because you constantly hear the glamorous pitch about tokenizing skyscrapers, putting fine art on the blockchain, and revolutionizing illiquid markets.
Yeah, the marketing is always flashy.
But looking at the off-view analysis, the reality of what is driving this network value today is surprisingly, boring.
Boring but foundational.
We are talking about real-world assets, or RWAs. The data shows that tokenization hit nearly 30 billion by April 2026.
That is a massive amount of capital.
It is, but when you look under the hood, the vast majority of that is just US Treasuries and money market funds, like BlackRock's BIDL fund.
There we go.
They are just using tokenized government debt as yield-bearing collateral in DeFi. The exotic illiquid assets are barely a blip.
Just a tiny fraction.
Right. Tokenized real estate is sitting at only 290 million. Private equity is at 200 million. I have to ask, if this technology is supposed to revolutionize global finance, why are we stuck just trading basic treasuries on a blockchain?
If we connect this to the bigger picture, it becomes painfully clear that simply turning a building into a digital token doesn't magically create a market for it.
fair point.
The Alfieri report actually outlines 3 massive real-world roadblocks.
What's the first one?
The first is secondary market liquidity. It's the classic cold start problem. A tokenized real estate fund is completely useless if there is no daily trading volume. You need buyers to attract sellers and sellers to attract buyers.
Okay, I get the liquidity problem. A tokenized high-rise in Manhattan is just a digital paperweight if there's no daily buyer.
Exactly.
But let's say we do find a buyer. Aren't we stepping into an absolute legal minefield?
Oh, big time.
Like, if I'm sitting in Tokyo and I use a decentralized exchange to buy a fraction of that New York building from someone in London, whose securities laws are we even breaking?
You've just hit on the second massive roadblock: cross-jurisdictional regulatory fragmentation.
Say that 5 times fast.
Right, but seriously, how do you enforce KYC, know your customer, and anti-money laundering rules across borders on a decentralized network?
I have no idea.
Well, if the smart contract doesn't know your passport country, it can't know if the trade is legal. It is an absolute compliance nightmare for the asset issuers.
Which naturally leads to the third problem I'm seeing in the research, the Oracle problem.
Yup, the Oracle problem.
For highly liquid assets like US Treasuries, the price is public. A smart contract can easily check a data feed and update the price every second. But how do you program a blockchain to know the real-time value of a commercial office building or like a piece of private equity?
You can't. You have to rely on a bridge between off-chain data and on-chain smart contracts. And for illiquid assets, that off-chain data comes from human appraisers. Humans can be slow, they can be wrong, and most importantly, they can be bribed.
Wow. Yeah.
It introduces a massive point of centralization and trust into a system that is supposed to be, totally trustless.
So if the actual assets are stuck behind these massive liquidity, legal, and pricing roadblocks, who is actually making money in the RWA space right now?
The people building the plumbing?
The plumbing?
Yeah. The real venture capital is flowing away from the flashy tokenized real estate startups and into compliance engines, cross-chain settlement rails, and decentralized identity solutions.
Identity solutions on-chain.
Exactly. The digital identity market alone is projected to hit $7.4 billion by the end of 2026. Because to trade regulated assets on-chain, you need verifiable human credentials built right into the smart contracts themselves.
It's the ultimate gold rush adage. Don't mine for gold, sell the pickaxes and shovels.
You got it.
And while Wall Street figures out the plumbing for these complex assets, the Silicon Valley Bank report highlights a much more immediate functional utility driving the market today: stablecoins.
Yeah.
They're calling them the Internet's dollar. We are seeing innovative protocols like Coinbase's by 402, which enable instant, scalable micropayments.
Which is a game changer.
It really is. This isn't just about trading anymore. It fundamentally changes how services can be monetized online. You don't need a credit card minimum. You can stream fractions of a cent for API calls, pay-per-second video content, or cross-border remittances in real time.
It fundamentally changes the unit economics of the entire internet.
Yeah.
When you combine the instant settlement of stablecoins with the massive infrastructure upgrades of Pectra and FireDancer, the blockchain finally transitions from a speculative casino into a foundational payment rail for global commerce.
So what does this all mean for you? If we pull all these threads together, the overarching theme of 2026 is maturation. We are watching the crypto ecosystem transition from a volatile, retail-driven experiment into a fully integrated institutional-grade financial infrastructure.
It's growing up.
Right. The brutal cycles are smoothing out thanks to ETF shock absorbers. The regulations are finally clarifying to unlock Tier 1 capital. The technology is actually scaling to meet consumer demand. And Wall Street is moving in to build the foundational plumbing.
And all of that infrastructure is laying the groundwork for something even more profound, honestly.
Oh, what's that?
Well, the Silicon Valley Bank report touched briefly on the conversions of AI in crypto.
Right, I saw that.
We are already seeing the rise of autonomous AI agents capable of managing their own cryptographic wallets.
Which is wild to think about.
It is, and it raises a really important question. If these AI agents soon become capable of executing high-frequency microtransactions around the clock, paying for their own server space, and negotiating smart contracts entirely on their own.
Yeah,
We have to ask, by 2030, will the primary users of the global crypto economy even be human?
Wow, that is a wild thought to leave you with.
It really makes you wonder.
We've gone from looking at a broken medical X-ray of market cycles to envisioning a future where the markets are literally running themselves. We've transitioned from predicting the seasons to handing the metronome over to machines.
It's a brave new world.
It really is. Well, thank you for joining us on this deep dive into the 2026 crypto landscape. Keep questioning the data, keep exploring the shifts, and we'll catch you on the next one.